Since taking over as Federal Reserve Chair, Kevin Warsh has introduced a different approach to monetary policy, and that has left some folks a bit uncomfortable. In this latest edition of LPL Street View, we wanted to provide our brief thoughts around the heavy lifting Warsh is attempting to do and what economic conditions may already be telling us about the likely next policy move. While many have spent some time sizing up the new Fed Chair Kevin Warsh, most of the attention has focused on his communication style. But the more important shift is likely his philosophical approach to the institution that is the Federal Reserve. Warsh appears less interested in managing market expectations through extensive forward guidance and more interested in allowing economic outcomes to drive policy decisions. He has emphasized simplicity, data dependency, and a willingness to reassess long-standing Fed practices through a series of internal policy reviews. In our view, that's best characterized as a pragmatic approach, one which positions the Fed as indeed independent and less compelled to be a primary driver of growth. This would effectively put the onus back on the strength of the private sector and less on the need for policy-driven outcomes. Turning the Titanic, however, will likely take a while, as for decades, politicians, the economy, and capital markets have leaned on the Fed to provide a shot in the arm. We believe that Kevin Warsh wants a less interventionist Fed, and to that end, rather than adhering to a predetermined policy path, Warsh has signaled a preference for responding to evolving economic conditions as they unfold. He has maintained a firm commitment to price stability, but he has not suggested that policy should remain restrictive simply to reinforce anti-inflation credibility. That's an important distinction for investors in our view. The most recent economic data suggests the inflation story is improving, not deteriorating. Headline CPI moderated to 3.4% year over year in July from 3.5% in June, while core inflation eased to 2.5%, continuing the broader disinflationary trend despite elevated energy prices. Just as importantly, labor market conditions are no longer pointing to an economy at risk of overheating. Non-farm payrolls declined by 23,000 jobs in July, well below expectations, and payroll revisions over recent months have been consistently lower. Wage growth has also slowed to approximately 3.2%, the weakest pace in more than 5 years. Taken together, these data points matter because they suggest inflation pressures are gradually easing while labor market momentum is indeed cooling. That's very different from an environment that would typically justify a renewed tightening cycle. For the Fed to hike rates again, we believe policymakers would likely need evidence that inflation is reaccelerating in a meaningful and a sustained way, while economic activity remains firm. Today, the incoming data points in the opposite direction. Inflation remains above target, but is moving lower. Employment growth remains positive on trend, but it is clearly slowing. Viewed through the lens of a pragmatic Fed chair, the hurdle for additional rate hikes remains high. The market continues to debate whether Warsh is fundamentally hawkish or dovish. We think that debate misses the point. The more relevant takeaway is that he appears increasingly focused on outcomes rather than ideology. If inflation continues to moderate and labor market conditions continue to normalize, a pragmatic Federal Reserve will eventually need to ask whether today's level of policy restrictiveness is still appropriate. That's why we believe investors should spend less time debating the possibility of another hike and more time evaluating the timing of the next cut. While the path may not be linear and Warsh's communication style may create greater volatility around expectations, the balance of the evidence suggests that the next move in rates is more likely to be lower than higher. Thanks for listening, and as always, allocate wisely.